Okay, we have a full house for market makers. So, market makers, everyone has about them an opinion, but often that is not true. And to try and explain, what market makers are, we have three of them right here on stage. So, Jason, we'll start with you. Introduce yourself and explain in your mind like what market makers do.
Thanks, Sam. Hey, everyone. I'm Jason Atkins. I'm Chief Commercial Officer of Aurus. We're a global market maker, liquidity provider, high-frequency trading firm founded in Hong Kong in 2017. We've been around for a little while. We trade on dozens of venues, providing liquidity on centralized exchanges, decentralized exchanges, working with all of the partners that require liquidity to maintain their best-in-class product. We work with dozens of project teams as well, providing liquidity to early-stage token launches. We also have a growing OTC desk that provides liquidity to foundations, venture capital firms, liquid funds, other investors that are looking to participate in crypto markets. So liquidity is really at the core of what we do and what we understand. And here today to talk about some of the misconceptions about what providing liquidity means and how we can clear some of that up. And I think the market will be better for understanding why liquidity is so important.
Okay, CJ, you're next.
Yeah, sure. My name is CJ. Thanks for having me here today. I run Asia for GSR. GSR is the oldest market maker in crypto. We actually founded in 2013. We're a global presence across London, the Americas, and APAC. We work with exchanges from their 0 to 1, 1 to 10s, as well as hundreds of projects over the history we've done. Besides that, we work with a lot of the institutions on the street with regards to OTC requirements, high net worth individuals, and we have a pretty large VC book. But thanks for having me.
Okay, Jordy?
Hey guys, I'm Jordy from Selene. We do a lot of trading, and part of that trading is market making, which is more about filling orders that other people want to trade against the market, as opposed to just trading your own orders. We can get into the distinction between the two, but yeah, I would say we don't consider ourselves just a market maker, but that's certainly part of what we do.
All right, so why do people on crypto Twitter think you're evil? What would happen to crypto without you guys here on stage? Jason?
Why do people think we're evil? I think when obviously we've been through a period of high volatility and price decline in the recent weeks and months, probably back to October the 10th last year. When bad things happen, generally narratives shift to looking for someone to blame. Stories are hard to piece together because it's imperfect information. Market makers are everywhere and very present, and then when they're not there, the markets dislocate quite a lot. I think flipping the script the other way is to look at those events and see precisely what happens when market makers are absent from the market, not by choice, but by dislocation in prices that are too volatile for markets to manage, but also the infrastructure blow breaks and you're unable to post orders. At the end of the day, we should want market makers and liquidity providers to be in the market as tight as they possibly can, as deep as they possibly can at all times to reduce that excess volatility. We can't avoid market moving events. We can't avoid statements from Trump. We can't avoid macro changes. We can't avoid new Fed chairs. The key is how do we reduce the excessive amount of volatility that occurs when liquidity evaporates? And for us, as we sit there and provide that liquidity, it's very obvious. But I think for a lot of market participants, not understanding that what they're looking at in a healthy market is oftentimes provided by liquidity providers. Not understanding that means that when it disappears, they then blame the very people that are essential to keeping it, holding it together. So I think that's where that misconception comes from. And as I said, when bad things happen, everyone's looking for someone to blame. But our job here today and in general, my team, we see it much of an education process to help people understand why we do what we do, why it's important, how we do it, and how our incentive alignment is aligned with healthy, sustainable markets that move towards mature levels that can attract new institutional investors and other types that can't trade in excessive volatility.
Yeah. CJ?
I'm going to address it from a different way. I think part of that misconception arises from a lack of understanding. Market makers is nothing new, right? Market makers within the world of Web3, it's not a new concept. And the reason why is market makers have existed in traditional finance since markets were created, in FX, equities, rates, across the curve. And I think the misconception is understanding that you can't use a singular bucket to categorize market makers. I think within that world, you have market makers, and look at the traditional markets. You have the banks on the sell side, your Goldmans, your Morgans, These guys create liquidity within the market. But on top of that, you then have that next level of layers, which is like the hedge funds, the faster prop shops within the market. And look, Web3 is no different. We have people like that. Each of our firms trades in a very, very different way with a very different approach. You have your core market makers whose sole job is to be passive, provide base level liquidity. On top of that, you will have prop trading shops come market makers who run their strategies. When you combine that together, what you are creating, and to Jason's point, which I agree with, is you create a healthy market scenario. The biggest problem we have is when expectations are very misaligned between what we are supposed to do and what we are regulated and mandated to do versus what the projects think we are supposed to do. A lot of projects think we wave a magic wand and the whole world gets rich together. It's not meant to be like that. We are one aspect of their business. Our job is to provide healthy, tradable markets, to create almost a football pitch where people can come in and trade. Their job is to build that product and encourage players onto the pitch. And I think that discrepancy is what's caused a lot of the angst against market makers. I've been doing this for almost 7 years, and we're still having the same discussion today that I had 7 years ago. So it obviously shows you that there is still that lack of understanding in the market.
So when someone's TGE fails, it dumps, it's not GSR's fault, it's the fault of the product not having to fit with the market.
Yeah, let's be practical. Let's talk about the concept of TGEs. Think about what you do, right? When you list on an exchange, when you do airdrops to your community, we get it. You want your community involved. But let's also call a spade a spade. By airdropping or giving it away to somebody, the first thing most people do is sell. Now, if you think about it, a market maker's job is not to be like Gandalf in Lord of the Rings and say, you shall not pass, right? That's called manipulation. A market maker's job is to make sure that any selling that comes into the market is done so in an orderly fashion because the books are there. And the problem you have is, as projects, when you TGE, your first thought process should not be, yay, we're on Binance, let's go grab a beer. Your first thought process should be, once we've TGE'd, once it's launched, well, who is going to buy my token and why? And I think that's the other side of the equation that many projects haven't figured out from day one. And that's where then it falls on us to say, well, you haven't done your job. Why? Well, my token price dropped 30%. Yeah, but all you've got are sellers. What do you expect to happen? And I think that's where there's a lot of miscommunication.
For sure. So let's blame tokenomics and the project, not people like yourself and Jordy.
Yeah, go for it.
All right, Jordy, what do you think?
Yeah, I mean, we're in post-1010 world, in a world where like liquidity's been pretty bad. And so to answer your question, like what does it look like if there's no market makers? I mean, there are market makers now, but you can already see the difference between like, healthy liquidity, and it's sort of been dwindling since the last few months. And the whole market has not been very healthy with it. And part of the reason is, very large players, large funds, if they're going to allocate money to a category or a token, they want to know that they can enter and exit within, a few days or a reasonable amount of time. And if they look at the daily volumes and the spreads and everything just looks like, it'll take weeks to get in and out of their position size, they're not going to trade that market. And while Bitcoin might be quite liquid, I think as you go down the curve, it quickly changes.
But surely there's enough buyers and sellers for Bitcoin and ETH, aren't there? I mean, not some random altcoin, but these are two major cryptos, right? What would happen to the market if we didn't have market makers trading Bitcoin, Ether, and other majors? Jason?
I mean, it goes to what Jordy was saying. It becomes a less attractive vehicle for investment for a number of different players. You look at time to execution, size of positioning, volatility. At the end of the day, the sign of a maturing asset class is a reduction in volatility. And we did see that through periods, call it the bull market or call it market stability, where the volatility of Bitcoin and Ether were dropping significantly. The problem with what we're seeing now is deleveraging events, lack of market makers being able to participate in the markets because, say, someone blew up or there's less of them in the market. It makes it harder for that asset class to mature. So if you were to pull that back even further and say there's no market makers at all in those assets, I would expect it would put the whole entire industry backwards on our path towards adoption, our path towards institutionalization, our path towards having new investor types that offset. You can't just have a group of speculative retail constantly trading something. That's a recipe for disaster. You really want a diversified set of investors. So to answer your question directly, if you pulled all that back, we would have a less stable market structure and a longer path to adoption than we already have.
For sure. So CJ, how do you stay neutral? Because you at GSR, you're not a Bitcoin or an Ether or whatever Maxi. You're GSR. So
Yep.
how do you tell the market that, hey, we are a neutral party, a neutral stakeholder, but you guys do trade Bitcoin, Ether, and whatever?
Well, when they come to the office in Singapore, I point to the wall, and there's a plaque from the MAS which says you're licensed. So if you do anything that's wrong, you go to jail, which is a great way of starting that conversation.
Yes.
But fundamentally speaking, it's what we're here for, right? And I go back to originally what I said. Each of our firms here looks at the market in a very different way. There's no right or wrong in it. It's how you're set up, what your strategies you employ are. We focus on the client franchise, which is why I think I've been here for 7 years. We've had more than 400 or 500 clients through our doors. At any one time, we have about 180 clients on the books in market making. We work with the clients, and we're very clear, right? Our job is, and it sounds brutal, but our job is not to worry if your price goes up or down. Our job is to ensure that you have books on both sides which are equal, which people can get in and out of it with minimal slippage, so they can trade based on the news you think, based on what you build. Now, the perception of neutrality has always been very important to us. We have never claimed, and we don't claim we're a prop shop, so we don't take prop positions. It's part of the reason why October 10th actually didn't affect us, because we don't have net positions. The only type of positioning that GSR tends to take is in the volatility side, and that's just by virtue of the business, and we net our long volatility for most of this. So it's one of the most difficult things, and the reason why is, let's be realistic, most projects, most startups, they like to hear that you're on their side, that you're going to be there to backstop them. Yes, there are ways to do that in a way that is not manipulation, right? It's called good advice, it's guidance, it's almost being the adult in the room with them, and that's what we pride ourselves on.
So when the client signs you, like a TGE, you have to tell them that we're not your counsel, right? We're not on your side, but we are part of your perhaps success as far as the market would want you to be successful.
I mean, on TGE, the way we do it with clients is, look, we ensure that the minute it's open, we're in the books. We ensure that if it's going up, if it's going down, our orders are the same. Now, obviously speaking, you don't have a scenario where you launch straight away and KPIs are hit instantaneously. That's technically how you blow up your risk engines. But we're there, right? And we help guide them in this journey. I think what a lot of project founders need, and we're seeing this more and more, right? Most founders are brilliant in terms of the vision, the tech they're building, where they want to go with this. But they're also pretty young. So what we do is, and the best way to do it in layman's terms is, we hold their hand. We're there to guide them. We're there to give them updates, tell them, look, the market's going this way. We're seeing this much volume come through. We're X% of your market share right now. We're going to see it sort of tail off and stabilize a little bit. So it's not like we're not there. It's not like we're not on your side, but we just won't manipulate the market for you. And that's a very important distinction.
I mean, that just to add to what you're saying, that's critical for every project that Aurus tries to work with. We spend a lot of time on the education and changing the misconceptions piece, because as soon as the expectations get out of whack, to your earlier point, it becomes very difficult to maintain our role as a neutral market maker to just provide liquidity and make sure that the projects have what they need from our side. It's still up to them to deliver on a product that has real product market fit, revenue behind it, a growth plan, a roadmap, tokenomics that matches what the market expects. But for us, it's to make sure that our founders that we're working with are really understanding what our role is and how we can do it best, so that there's no misalignment of expectations. For
sure. So Jordy, do you see these guys on stage as competitors? Like, why does the market need multiple market makers?
I mean, we always suggest a project get, 2 market makers. If it's a huge one, maybe 3. The reason is generally, like, if they want to have tight spreads, we can't always be like, 2 bips wide, 5 bips wide. We might need to be 10 bips wide, 15 bips wide. But if we have a slightly different view of the market, then when you kind of put the 2 spreads together, then it does end up being, much healthier for them and creates more activity, more volume, more different opinions. We have a slightly different way of pricing the model. So there's always a need for more than one market maker, I would say. And so both competitors.
Yeah. I mean, it's a healthy way, right? It's very similar to banks. You need that choice. You need that. And the reason why is this. For many clients out there, a relationship with your market maker, if you're the type of client that every day you're calling your market maker and saying, what are you doing to the market? What are you doing to the market? What are you doing to the market? That's probably lack of trust. Yeah. But you may find that trust with another market. We're all very different in how we look at it, what we see are important. But we're all within the same market, and we all have the same goal. And that is to make this market healthier, more stable, and to Jason's point earlier on, to really show as that lighthouse where institutional money looks at it and says, this is a market I want to be involved in right now.
Definitely. So a recent story we had in CoinDesk was that both Kalshi and Poly Market have hired a market maker to help their books. So how would that work theoretically? Like, how would a market maker come in with prediction markets and help them without taking an endorsement on one side of the question about, say, a Fed rate cut or a election, that kind of stuff?
It goes to any venue. It doesn't have to be prediction markets, Kalshi, Poly Market. Any venue that is providing markets to their users is looking to have stable, deep liquidity for people to trade. Prediction markets obviously are newer and very illiquid still. Like if you look at the volumes that are going through, in aggregate, they're large. But if you look at some of the smaller prediction markets, it's hundreds of thousands of dollars. They're very difficult markets to make. And the recognition of deals like this that are reported in the press is what the participants can see is that the venues themselves understand the importance of having cornerstone liquidity to bootstrap the process so that retail and users have something to trade against. This is no different from deals that exist in traditional finance, linking market makers to exchanges. There's no different to deals that exist between exchanges and market makers to help bootstrap liquidity. Stablecoin issuers do it. They're trying to make sure that as they're pushing their roadmap of adoption, whether that's an individual token or a stablecoin, that there is liquidity in the books to do it. So these deals are commonplace and, in my opinion, essential to the market structure as you start to grow. You cannot go from 0 to 1. You have to build bit by bit and make sure that things are stable all the way along.
So I guess it would then help these venues because you could have more niche questions that some whale can't manipulate, right? So if you have a question that only has, say, $50,000 of liquidity, a person could come in and buy one side of it and say, oh, this will result in this. With market making, I guess it's more of a liquid market, so you don't have that option for manipulation.
I mean, the economic incentive is always out there for someone to manipulate a market to make money. The easier that task is, the more often it will happen. As books get deeper and liquidity gets tighter, there'll be attempts, but you never know whether there's a big pool of liquidity out there that you can run into that stops what you're attempting to do and you end up losing money doing that. So I think it goes to the same point. As markets mature and get more liquid, less adverse scenarios like attempted manipulation from whoever the bad actors are out there happen, and therefore volatility drops. And as that volatility drops, the participants that Geordie spoke about look at the asset class and go, oh, I can put on my position in size, a pension fund, in size in a short amount of time. And when I decide to get out of it for whatever reason, I can do so without taking a huge loss
without massive slippage.
Exactly, yeah.
So CJ, last year was pretty big for the market, pretty exciting.
Yep.
What does this year hold for market makers?
I mean, so what's in vogue, right? And what's in vogue is two main topics. I think 90% of consensus this year is going to cover these topics. RWAs is something that everybody's looking at. That concept, and interesting enough, the most successful RWA has actually been around for a while. It's actually Tether, right? It's USDT if you think about it. I think in this direction, for market makers, and I'm going to blow our own horns here, we become more imperative for these markets because, as Jason said, most markets don't go from there to there. Most markets start like that, and you slowly evolve. Even back to your prediction market question, which is very similar. Part of the reason why we saw a competitor and the market maker signing a deal with these companies was, at first, these companies wanted to do it in-house, which completely doesn't make sense because technically then everyone who uses that market is betting against the house, and it shouldn't be these situations. Prediction markets evolve from the concept of sports betting. And I think on top of that, what you're going to see is I feel right now prediction markets, we've sort of overshot it a little bit. If you go and look at some of the things that people are betting on, you're like, that makes no sense at all. But you kind of feel like it's going to normalize. And when that happens, more and more players can come in on a more rational basis to provide, for lack of a better term, the right odds for doing something like this. RWAs this year, I think, is going to be crucial. With that comes the concept of how do market makers in Web3, how should we look at things from a security aspect? And the reason why is many of these RWAs, they are classified as securities. So the way it works in the market, it's almost bridging between what we've always done in Web3, but now we're starting to touch the Web2 world. So this is going to be a very interesting year for something like this. And I think it's something that all of us here on stage are excited about. And I'm very, very sure we have our teams looking at both of these segments to figure out where is our place within them.
What's the challenge you see in the future for this year?
So I think there's two challenges, right? On one hand, if you talk about native Web3, it's the fact that we have multiple flushing events every single time, and it scares people. But the reality of life is flushing events happen in everything. I remember I began my career on Wall Street, and I saw Lehman's lights change to Barclays. And that was a flushing event. That really killed a lot of the market odds. But after that, you had the Greece crisis. It just keeps continuing, right? And I think we have to understand that this is a massive part of it. And so this sort of stabilization, maturing in the space, is going to be very important for what we stand for. The other part that's a difficult part now, I think, is as we start progressing into the RWA discussion, for good or for bad, I do think we're going to see a lot more of the more traditional market makers, financial institutions come in. That's going to make it very interesting, right? Yes, for us, do we see it as they're coming in to eat our lunch? Not really, because we have an edge where we see a completely different side of the market. But there is going to be that clash. And I think that in the net long term, it's going to make the market a much more efficient and healthier place there.
Okay, Jordy, what do you think?
Yeah, definitely like the decentralized exchange part of the market is growing a lot. We say that every year, but like now it's definitely happening. Obviously, we have multiple strong competitors to like the centralized exchanges, and certainly like on the RWA space, which is one that we're actively participating in. It's pretty clear that a lot of these new markets are sometimes growing faster on the decentralized side. You see like Hyperliquid and Lighter and some of these other dexes are trading higher volume than the centralized exchanges on these products. So being good at managing that world and getting kind of a bit more blockchain native and understanding the actual blockchain of it rather just centralized API, I think is maybe what's going to help us protect from some of the citadels of the world that are not used to that.
It's actually a good point with DEXs. So they have AMMs in the background. If we have automated market makers, why do we need you guys?
So even the ones that have like, so you're talking about spot AMMs, but for perpetuals, for example, there's often a need for either a vault of some sort, but somebody has to run the vault. Sometimes it's market makers running the vault. And then if there is no vault, you still need a lot of people in the books to provide liquidity. But if you saw silver recently, like the amount of trading that was happening on silver was insane. I mean, I think it was like Bitcoin and then silver and then ETH. So it was literally the second most active market in all of crypto. And those markets need market makers for bootstrapping. Sometimes it's like you're more like you're helping the venue rather than helping silver. Like silver is not calling me up asking me to quote for
There's
it.
no silver Satoshi. There's no boss of silver.
But you might get Lighter might call me up and say like, hey, can you help us show a silver market? So sometimes our clients becomes like the exchanges rather than the product.
It's no different to the centralized piece. It's decentralized perp-dex growth still needs liquidity, still needs market makers. AMMs exist in a separate sort of vacuum, but it's essential that these venues bootstrap the liquidity if they want to become viable competitors. One thing we have to be very careful of is liquidity fragmentation. Yep. It's becoming easier and easier to spin up a fork of something else, new venue. The question is, how many venues can Geordie support? How many venues can CJ support? How many venues can Aura support? We don't have infinite capital, infinite liquidity. So it's very important that the market tests these products, tests the product market fit, ensures that the best product wins, that gets users and usage growth, and that liquidity concentrates there. And you'll see consolidation. I mean, you see it in every industry. You'll have tons of choices at the start, and then the market works out what the best one is. Everything ends up there, and liquidity will do the same thing. So for us, we look at the landscape. We trade a lot more on DEXs than we did at the start of Aurus, obviously, as the market growth has indicated. But it's very important for us to identify where we think the competitive edge is at the venues, which ones have a unique difference that will attract users and need our liquidity the most. And we devote our resources there.
And we are out of time. We'll leave it right there. Guys, that was great. Thank you.
Thank you very much.
Thanks,
Thank you. Cheers.